I have some sympathy for you, sir, because the earnings calendar for big tech, the big names in the space of, 48 hours. Now, Tom, I won't ask you to pick your favourite baby, but if you had to pick one earnings report right now that I could give to you, Tom, what would it be?
So if I had to see an earnings report right now, the one that I want to see is Amazon. So I'm curious, the term I think that you're going to see this quarter is beat and layoff. So to what extent are these big technology companies laying off employees but still outperforming against expectations? So I think that these layoffs put these companies in a position where it's more difficult for them to show better than expected sales and profits. Because if they had better than expected sales and profits, why are they cutting headcount so significantly?
It's a really important question, Tom. So let's ask the question as to why Apple isn't cutting headcount.
So Apple will cut headcount. They'll do it in one of two ways. If you look back to Amazon, between the first quarter and second quarter of last year, they cut about 100,000 heads, mostly at the fulfillment center level, when they acknowledged that they were overbuilt for the current level of demand. So Apple could cut by attrition, much like Amazon did. They've been one of the companies who's been in the news for wanting their employees to return to the headquarters, to return to office for a greater period of time. They could assist on that and then have some attrition there. They could also lay off their employees at the retail level. So I do believe that Apple, while they haven't done so yet, like everyone else, they will adjust their headcount for the current level of demand.
So far this year, Tom, any kinds of announcements of layoffs has been met usually with a rally in the shares of the company, with this feeling of cost cutting that would allow growth to continue to accelerate. At what point is that not true anymore for the tech complex?
So the question is, are they cutting fat or are they cutting muscle? And I think to some degree, a lot of the cuts have been fat. These companies were bloated in terms of headcount, especially bloated given the low level of demand for e-commerce today and for digital advertising. So the question is, at some point, are they cutting muscle and not fat? That remains to be seen. But I think that the reason you're seeing the stocks react favorably to the headcount moves is on the expectation that on a near-term basis, it'll result in higher margins on lower expenses.
There are a couple different strains of ideas for the economy within these tech earnings. There's a business side, particularly with cloud computing and the spending that you've seen, or not, with the disappointing outlook from Microsoft, which potentially we might see repeated by Amazon's AWS. And then there's the consumer side, the consumer still buying and Apple continuing to be strong on that level. Which prong do you think has the greatest weakness? Are we seeing some of the bigger softening?
Yeah, the greater concern, and this pertains to Amazon, from their third quarter results wasn't that their mature e-commerce business was slow growing, it's that their faster, higher margin units, cloud computing and advertising, were starting to feel the negative impacts of an increasingly challenged macroeconomic environment. So to the extent we see more signs of that when Amazon reports, I think that's the greater concern, given that it's higher revenue, higher margin for Amazon.
Let's build on that, Tom. Barron's wrote about this weekend. I think it's the question to ask for these tech names right now. Are we seeing some of these names face just a little bit of a cyclical test? Or are we seeing some of the structural story that's dominated these names and delivered monster gains over the last 5 years or so? Are we seeing that structural shift, a change in the underlying trend, Tom, that could be with us for years to come, regardless of the cycle?
I'll go with the structural shift. I think that gone are the days where you can get up and expect Amazon, Apple, Alphabet, Meta platforms to outperform against NASDAQ automatically. I think you need to see some company-specific initiatives, or in the case of Alphabet and Meta, a rebound in digital advertising on a strengthening economy for those shares to outperform the NASDAQ even over short periods of time. So I would say it's more structural. I think it's a change in dynamics, and I think it's something that's going to continue to play out over the next 12 months.
Tom, how does that influence your thoughts on how we should be thinking about valuing these companies with that in mind?
Well, the challenge for Amazon long-term is in order to maintain its premium multiple, they essentially have to outgrow the contraction in their multiple from an earnings standpoint, which is why you're seeing such a significant shift in focus to services, to higher margin efforts for Amazon. But the question for all these companies in big tech is, can they outpace the contraction in their multiple, perhaps by having their profits grow at a higher than expected rate? And I think it's going to be a challenge across the board.